Hi there, Jason Dalbey with Invest Denver. Today we're going to talk about what is a cap rate, how is it calculated, and how do you apply it to your investment. A cap rate is the most popular and widely used metric to apply to your real estate investment to establish a value. The cap rate simply represents a yield that on your property, if you bought that for cash over a 1-year time horizon based on the income that it generates. Cap rates can vary based on property location, property type, and property condition. For instance, in Denver here, we have general cap rates of anywhere from 4 to 8%. In other secondary, tertiary markets, you might see cap rates into the 8 to 12, 13% range. Recently in Denver, we've actually seen our cap rates compress. So the cap rate goes down, which means the values are going up and the incomes are going down. Not necessarily an ideal situation for an investor. However, it is a strong indicator that our market is strong and people do want to be here. We are a very healthy economy and a healthy real estate market. The cap rate is calculated by dividing the net operating income by the purchase price or the value of the building. So for example, a property is being marketed for $1 million and it has an advertised $60,000 net operating income on that offering memorandum. You take the $60,000, divide it by the 1 million, and you get a 6% cap rate. You can also derive a value of a property just sort of working backwards. If you have the income and you have a general cap rate for the area, you can come up with a value that you want to offer on the property. So for instance, the net operating income is $250,000. You've got a cap rate of 5% in your market. $250,000 divided by the 5% gets you a $5 million value of that property. In addition, as your net operating income grows and the cap rate stays the same, well, the value of your property just increased. Using the previous example, if you were able to grow that $250,000 of net operating income to $300,000 of net operating income, and your cap rate for the area is 5%, well, now the value of your property just grew from $5 million to $6 million. So by adding $50,000 of net operating income, you've increased the value of your property by $1 million. How crazy is that? Just remember that the cap rate is not the end-all be-all valuation metric used. You've really got to do your own due diligence and dive in. It also doesn't account for your loan obligation, so the debt that you put on the property can really impact your cash flow. Thanks for listening. If you have any questions, please leave them in the comments below. If you found value in the video, please like it, subscribe to the channel. Thank you very much.